All right. What's up, everybody? Welcome to a very special episode of Forward Guidance in collaboration with the 1000X Boys. We're hosting this live from Permissionless. We're in day one. I just ran off the panel and just sprinted over here to connect with you guys. It's great to have you. I've wanted to do this for a while and connect with you guys. I love the way you both think. So maybe we could just have you introduce you both and what you focus on.
Hey, yeah, thank you so much for having us on the pod. This is awesome, and this event is awesome. Just looking around, seeing so many people come out to Permissionless. It's been fun so far. So for those that don't know me, I'm Avi Fellman. I've been in crypto now since 2017 and professionally trading it since 2019. I've been across the entire spectrum working at a pure crypto native hedge fund called Block Tower for a few years, where I was the co-PM of that, managing the book alongside Ari Paul. And then I ended up starting the crypto division at a traditional hedge fund called Golden Tree, which I ran for about 2 years before now overseeing the exit of that fund to Republic, and now trading my own book. So it's a pleasure
Awesome.
to be here with you.
Yeah.
Pleasure to be here as well. It's a real honor. Thank you for setting this up. My name's Jonah Van Borg. I've been a trader for almost 20 years professionally. I've traded most asset classes, not interest rates, so I got lots of questions for you on that, but the bulk of my career I spent running crude oil trading businesses, first at Goldman Sachs. I ran the crude derivatives book, and then I was a partner at Vitol for 7 years. That's the world's largest oil trading company, doing derivatives and physical. And then after that, I spent 2 years running DRW's crypto and precious metals trading operations called Cumberland. Now I'm just an energy and crypto trader and more macro kind of mindset.
Nice.
So, same as Avi.
Awesome. And yeah, to the 1000X listeners, I'm Felix, host of the Forward Guidance podcast. Go on Twitter as Fijo. I've been a pretty avid participant and listener to you guys' live streams. Really enjoy it. So it's going to be a ton of fun to be live here. And yeah, just in the spirit of being a collaborative episode, I'm going to ask some questions to you guys. You guys are going to ask me some questions. We're going to have some fun back and forth. But yeah, I want to get into it. I want to ask Jonah some questions about oil and the energy space. Getting right into it here. So obviously there's been a lot of geopolitical conflict, and that's been leading to some idiosyncratic moves in oil and energy markets. That's a realm that I have, I'm pretty happy to admit I don't have any edge in whatsoever. But like you said, you've been an oil trader for a very long time. So I'd love to just get your take on what are you seeing there and what's your perspective on it?
Yeah, I'm glad you asked. Oil is a very misunderstood market. It occasionally is relevant to other markets that the broader macro space pays attention to. Now is one of those times, and you see the tourists come into oil and they don't know what they're doing. So let me just give you a quick overview of the situation. The world consumes about 103 million barrels a day worth of oil. Barrel's about yay high, holds 42 gallons. It's a very physical market. There's about 105 million barrels a day, so in excess of roughly 2 million barrels a day of supply capacity out there, but Saudi Arabia and their OPEC friends are withholding that from the market to keep prices artificially high so they can fund their vanity projects, essentially, and budgets. So the market is essentially very oversupplied were it not for this cut. And geopolitical risk is relevant when the market is not oversupplied and when there's no spare production capacity available, because then if production goes out, the price can really spike. Demand is inelastic with respect to, you're going to drive your car until you can't, right? So you can't afford to. You have to get places. It's such an important commodity. So just to wrap this thought up, because there's such a spare capacity buffer right now, the geopolitical risk doesn't matter as much. Basically what this boils down to for macro listeners is, will the conflict in the Middle East escalate to a point where more than 2 million barrels a day of supply gets cut off from the world? Neither Israel nor Lebanon nor Iran even have enough. Well, Israel and Lebanon don't produce any oil. Iran they export roughly 1.6 million barrels a day. So even if you took out all that production, it wouldn't cause a spike because the rest of OPEC could jump in and plug it. The one thing that could screw every single market over would be if Iran shuts the Strait of Hormuz, through which 30 million barrels a day of oil flow. So keep your eyes laser focused on whether or not they go and do that. And if there's kinetic war in the Straits, then all bets are off. Macro is going to tank and oil is going to go to $200 a barrel. I'd say the probability of that happening is less than 5%.
Yeah.
And absent that, there's no risk.
Yeah. So do you mostly react, or do you try to forecast what's going to occur geopolitically? Obviously, we're all waiting to see how Israel reacts to Iran after Iran sent a bunch of rockets at Israel. So do you forecast any of that or play probabilities, or you just wait to see what happens and react?
In oil markets, unlike crypto, I am a very systematic trader. I have a mean reversion strategy and a momentum strategy, which are each comprise sub-strategies. Now is a time where you turn off your mean reversion strategy because there's a risk of a spike. Now is also a time when you turn off any momentum strategies that get you short because you could get absolutely blown out to the upside. That's sort of how I do it. So I just turn off elements of my portfolio in environments like this. So basically what I'm long right now is diesel, because that's the only part of my portfolio that the robot wants to be max long.
Yeah, interesting, interesting. Avi, I want to talk to you a little bit about how you use macro into crypto. Obviously, you're a pretty in the weeds crypto trader. That's your bread and butter. Jonah, obviously you're deep in the crypto trading as well. But Avi, just want to let you open up about what's your high level process. How do you think about macro dynamics in terms of how that impacts crypto, and how much do you weigh it versus some of these more idiosyncratic like market structure things that you really focus on as well?
I mean, it's a really good question, and the answer is twofold. You have to think about the time frame of when you're using macro to trade crypto. I think over a long enough time frame, there's actually a pretty significant decorrelation between macro and crypto. So if you're looking on a 3-month time frame, for example, or a 2-month time frame, it's possible that you can see equity markets go down when there are idiosyncratic things that might be driving a crypto bid. A great example of this is for the month prior to the appearance of Donald Trump at a Bitcoin conference, Bitcoin actually went up substantially from mid-50s almost to $70,000 while equity markets were going down. And it was very confusing to people why that might be happening. Yeah. And it was because there was an idiosyncratic explanation. People were speculating on what Donald Trump might say at this conference. And the reason that happens is because still, even today, the crypto markets can be moved with a few $1 billion. With $10 billion of movement, you can change the price of Bitcoin. And that is not true of the equity markets, right? And the reason that crypto tends to go down or up with the equity markets is because of cross-holder correlation. So let's say the equity markets are up 3% and Bitcoin's flat, it's going to cause some people to want to go buy Bitcoin because historically it's been correlated, but only a certain amount of capital will be allocated to that. So with that in mind, the way that I use macro on a day-to-day basis is to look for short-term divergences. So I don't think it's a smart thing to say, hey, over the last 2 months, the equity markets are up 30%, Bitcoin's up 5%, therefore Bitcoin will catch up. Because there are too many other factors involved. Yeah. But on a day-to-day basis, if I say, okay, well, dollars down, and dollars down a lot, what should Bitcoin do? Well, maybe it should go up short-term a little bit. Right? But will it go up over the next week? I don't know, and I don't think so. The thing that I have found over a long period of time is most correlated with the price of Bitcoin are interest rates. That's it at the end of the day. I think that Bitcoin tends to thrive in low interest rate environments and tends to do poorly in high interest rate environments. And it's about the forward look from there. So on a day-to-day basis, it's about figuring out where there's short-term discrepancies, and on a medium to long term, it's really just about interest rates. Yeah, my personal opinion.
Nice. Guys, I want to ask you a little bit. You know, Jonah, you were actually on the Forward Guidance podcast a couple months ago when Jack interviewed you, and you laid out your long-term, fundamental views on Bitcoin and the crypto space, especially how it relates to macro in terms of like a reserve collateral. But I want to ask you both just to get your one-page reviews on for our audience on the Forward Guidance side of things that maybe are crypto skeptics and mostly focus in on macro. Why do you guys care about crypto, being both guys who have also been on the TradFi side of things? Maybe starting with you, Jonah.
Yeah, it's a great question. Glad you asked. Basically, let's separate crypto into two things, Bitcoin and non-Bitcoin. My elevator pitch for why TradFi should care about Bitcoin is that it keeps central banks honest. And furthermore, Bitcoin is objectively a better store of value, maybe not a better means of exchange, but definitely a better store of value than, let's call it, 100 of the world's 150 fiat currencies. So there's no debate about that anymore. If you live in Chad, would you rather hold local fiat or Bitcoin if you're looking to preserve wealth? I don't think there's a debate anymore. So to the extent that we now live in a sort of a post-gold standard era, I think it is important for something in this world to be keeping central banks from printing money with reckless abandon. I think Bitcoin is that thing. And I think that the rest of non-Bitcoin crypto, we don't have time to get into it here, but it acts as a similar foil to centralizing forces in technology, which I think ultimately lead to bad things in society. That's my kind of overarching thesis for why it is that the world should at least treat Bitcoin as a good sort of tail, maybe 1% to 2% of your portfolio, even if you hate it. It's gonna gain value as governments print and debase and abuse.
Yeah. Avi, how do you look at things in terms of like the high level fundamental? We can look at like price structure separately, but what's your fundamental view?
I mean, Jonah, I agree with you 100%. And I think it's really difficult for people in stable countries to wrap their head around this. And this is just, that's been the thesis, I think, since the beginning. Since Bitcoin was created, it was, hey, there will be central banks, there will be governments that will act irresponsibly. And how do we protect ourselves against that? Historically, there hasn't really been a way other than by hoarding precious gemstones or metals. And so how do we build a system or a currency or a money that protects us against governments basically messing up? And for the longest time, it's like, well, okay, we live in the United States. Why does it matter? You might live in Canada. You might live even in China, where it's still been reasonably stable, and you might think to yourself, okay, well, why do I need this? Right? And the answer is, you might not, but the rest of the world does, because every year there's a currency that effectively fails, and they don't have any other options, right? They don't have anywhere to go. And so that's why I think Bitcoin is extremely valuable, is because not only does it protect people that are currently experiencing the situation, it protects you against potentially experiencing the situation in the future. There are a lot of things that we have said, oh, that's impossible, that's never going to happen in the history of this world, and then sometimes they end up happening. And so there's some argument to be made, okay, well, if there's a 1% chance of this catastrophic event happening, if there's a 0.1% chance of a civil war in the United States of America, well, what value does that assign to a currency that exists outside the bounds? Even if there's a 0.01% chance, right? So, you think in terms of probabilities, which I think people have a problem with. It's always been, for a lot of people, it's binary. It's, is it going to happen and is it not? No, of course it's never going to happen, therefore this should have no value. Well, no, there's always some percent chance, right?
One other
That's
thing,
the way that I think about it.
I love that. And one other thing I would just add on top of that point is the idea that even if there isn't like a destabilizing event in the United States, like a civil war, we may indeed find, and this has happened many times in the history of global commodities trade, we may find that as the sort of Cold Wars of the world between, say, China and the United States accelerate and become more acute, and as sanctions and banking restrictions accelerate, Bitcoin may indeed become one of those few currencies that can perforate the kind of Orwellian hemispheres that get erected as part of that. Like, the global trade is dollar denominated right now, but in the future, if you want to ship a cargo of crude oil from Texas to the Shandong province in China, that transaction may take place in Bitcoin because JP Morgan might not be willing to send that transfer, which is how it currently works, literally. So I think that big ticket transactions, not buying a coffee, but like buying a cargo of crude oil for $180 million, that may indeed take place with Bitcoin.
Yeah, well said. Well, maybe what we could do here is do a little host swap and open it up to you guys, just to hear a bit about like what you guys are wanting to talk a bit about. I know you had a couple questions for me. Happy to talk about anything macro, but yeah, what's on your guys' mind and what are you wondering about?
One thing that I've been struggling with, and curious how you take it, is the trade in 2022, November 21, was that as the Fed started to raise interest rates, Bitcoin basically went in a straight line down. And that was a reaction to, quote unquote, understanding what made the money. In 2021, the money was made because there was a tremendous amount of injection of money into the financial system, right? And a lot of this ended up with Bitcoin. And so the question is now, as the Fed is starting to cut again, Bitcoin hasn't really done anything. It's kind of remained flat. Equities have gone up. And I think a lot of people in crypto are wondering, well, why is this not just the direct opposite of what happened in November 21?
I'm a bit surprised that we haven't like truly broken out here with respect to what you're talking about. So, yeah, rewinding back to a few years ago, we've been through a pretty clean cycle, like you say, is that we saw the Fed take rates to zero, we saw QE infinity, we saw everything happen in 2020, and then we saw the crypto market just absolutely go gangbusters for a couple of years. That happened, and then we had the opposite occur where inflation really took hold. They had to start to hike rates a ton. And we saw it going a straight line down. Things started to get a bit different around early 2023 for a variety of idiosyncratic and also macro reasons. So the macro game has changed a bit because of some of these dynamics that you guys both hinted at a bit about in terms of just how much debt is in the system and how much we can really let this entire debt-based economy totally unwind versus try to keep it in check. So what has happened is that from 2023 onwards, we've seen this baton of easing be passed to these more shadowy, hidden institutions. So one example is the Treasury. There's been a great academic paper that's come out that's coined it active Treasury issuance, where basically by having Janet Yellen and the TBAC advisory committee issuing bills and avoiding issuing duration on the long end, it's sort of a mirrored effect of QE. When you look at what QE is, quantitative easing, is that it's just removing duration from the market by buying those long end bonds and swapping it for central bank reserves. What ATI or active treasury issuance is doing is just stopping it at the inception. Instead of even letting it go in the market, they're just avoiding putting that supply into the market and just shift it over to the bills. So even though the Fed was hiking, and we can also debate about the effectiveness of hiking interest rates during this world where everybody was locked into a 30-year mortgage at 2-3%, and as long as they don't move, they're not affected by the rate hikes. Companies, they termed out their debt at really, really low levels, and as long as they didn't have to change anything there substantially, they could just ride out the rate hike cycle as well. There's way less floating rate debt out there versus fixed rate debt these days. So there's a couple dynamics in terms of the effectiveness of rate hikes, as well as these other distinctions in terms of what the Treasury's been doing. There's been a lot of people that have looked at the reverse repo facility come down from $2 trillion to $300-400 billion that it's at now. The TGA is the same thing. So there's been these more idiosyncratic dynamics that have thrown off this traditional cycle. So it's not as easy anymore to just look at, Fed is cutting, things go up. Fed is hiking, things go down. There's these more idiosyncratic factors. So where are we at now? We've had a 50 bps rate cut. If you're going to ask me the reaction, we've done really well. Relatively speaking, equities have certainly done really well. They're hitting new highs every day. Gold's hitting new highs every day. Bitcoin is lagging. I think it takes time, and I also think there's a lot of confusion in the markets right now. There's a lot of people that are looking at things like yield curve inversions, which I think have issues in terms of signal, that is throwing them off and thinking we're on the precipice of a recession. There's a lot of labor market data that's incredibly noisy right now, so it's difficult to get signal. So I think there's a lot of people that haven't gone through the motions and done the work to realize that we're actually in a very different regime. Like, there's some people that are saying we're at the end of a business cycle. There's some people that are saying we're at the beginning of a one. If you look at consumer lending uptake and business lending uptake, that looks like an early innings of a business cycle. But then you look at where the Fed is at, you look at where unemployment rate is ticking up, that looks like the end of the cycle. So there's a lot of confusion. I think as we move forward, that confusion will be less confusing. I think we're going to get some clarity here. Obviously last Friday's non-farm payrolls print provided that. I was pretty confident that we do pretty well there, but even that is a substantial outlier to the upside. So I think a lot of people are just confused.
Yeah.
But it's clear where we're headed. I've personally done the work and gotten to a simple framework for myself, which is that, okay, the Fed is cutting rates. If the Fed is cutting rates into what's an imminent recession, that's probably going to be a bad thing, because they're going to have to cut rates a lot more to get underneath this thing and actually stop it and then reverse higher. That's why we normally see those V crashes in assets until they get underneath this thing. But if we aren't seeing a recession, but we're cutting rates into a resilient economy, that's, in my opinion, extremely bullish.
Party time, yeah.
It's party time. But it's almost party time to the point where it could be concerning in a couple of years, even end of 2025. I'm not a huge believer that inflation is going to come roaring back next week, but the risks are increasing. So I just think there's a lot of confusion, and people are trying to sort through it.
I'm confused. I'm glad you broke it down there, because to me, the interest rate picture is the part of the macro asset kind of puzzle that I understand the least. And like Avi, I just think, rates high, Bitcoin bad, rates low, Bitcoin good.
Yeah.
But I think it's more nuanced than that. And I think for me, the framework, I want to get your take on this. My framework right now is own risk assets, stocks, Bitcoin, especially Bitcoin, until one of two things happens. Number one, Bitcoin gets overvalued by your sort of, let's call it hyper white hot bull market metric, MVRVZ going above 5 or 6. That's probably when you take profit. But even if that doesn't happen, I think the other time when you sell Bitcoin is if you see a redistributionary political shift, like Bernie Sanders or an AOC, have a legitimate shot at the presidency, or if that movement takes charge in governments across the world, especially the United States, then you're probably supposed to sell. Otherwise, if that doesn't happen, then we're probably still in the kind of 2008, post-2008 regime of governments basically backstop and underwrite all risk that goes on in the economy, and anytime there's a recession, it's going to be V-shaped because they're just going to sweep all that risk onto their balance sheet. So that's my framework. Do you agree with that? Do you disagree with it? What's your interest rate mind tell you about that perspective?
Yeah. So something that I haven't talked about yet is the world we live in now in terms of the Fed reaction function is actually quite different from 2008.
Okay.
And the big change, to put it in simple wording, is we live in this world of forward guidance. Like, if you just look at the amount of Fed speeches in the last 2 weeks, it's fucking ridiculous. Like, just so many Fed governors are talking. You compare that to 10 years ago, very different world. We have the summary of economic projections every quarter now. That's a new thing. We have the Fed that does press conferences. That's a somewhat new thing as well. These ideas of forward guidance are relatively new in terms of monetary policy historically. So that creates a lot of different signals that get priced into markets fairly early on. So this is the dynamic that people talk about where it's like, yes, we're going to get rate cuts. We just had a rate cut, but so much of that forward guidance baked it in early on that it's very different from the old Fed that had very little forward guidance. So their change in Fed funds rate was a lot punchier because it wasn't as priced in. So that part's a bit difficult. And sorry, what was the end of your second question?
Just to ask one question there. When did that start really coming about?
So basically, it was around like 2010, 2011-ish. The issue was the Fed funds rate was at 0, and they were still seeing deflationary concerns. So, they started to do QE. That was one. There's a famous paper that basically laid this out. These Fed governors go to these big symposiums and show off their academic papers. And one of them was about tools to use when we're at the zero lower bound. So one of them was obviously the proposition for QE that really took hold, but the other one was actually around forward guidance and guiding the market so that even though rates are at 0, by saying, hey, we're not going to raise rates for at least 4 years, the market can actually price that in. So it was tools that were created. Now the thing is, we're not at the zero lower bound anymore, but we still live in this world of forward guidance. So it's created these weird dynamics that aren't as clean anymore.
Understood.
Where are they guiding us now? Where are rates going to settle, you think?
So this is the other thing. This is what's been also happening in the past few weeks, and I've been talking a lot about this, is that if you look at, say, like long bond yields, after the Fed 50 bips rate cut, they actually increased, which is confusing. And this also reflected a higher dollar. So the DXY went higher since the 50 bips cut, and a lot of people were confused. The reason that occurred is because of the guidance and what was actually priced into the curve. So, going into that meeting, we were pricing, roughly a terminal rate of 3%, and it was just about the path that we got there. So, the Fed came in with their SEP of summary economic projections, which, I don't remember offhand when we would get to that 3%, but it's basically going to take longer than what the market had priced in. The market had priced in that we pretty much get to that 3%, which a lot of market participants think is like the neutral rate. So, it's not even like easing necessarily, but it's just that neutral area. So because that velocity of how quickly we get there, the market had overpriced it. It had to take out those. At the same time that we got the 50 bips cut, which means that they're getting ahead of this growth scare that we've been seeing, which means they're going to have to cut less, which means we actually have to price out cuts later on. which means that economic growth is decent, which means that long bond yields actually have to go up, which means that the dollar needs to go up because it had priced a way more aggressive cutting cycle. So there's all these weird things like this that it's not as simple to just looking at, Fed cuts, game on,
The reason why I'm conviction long Bitcoin and stocks is because if we're in a growing economy where things are great and they cut all the way to 3%, like you just said, it's, like I said earlier, party time, off to the races.
100%.
And if we go into a recession, they've got another 3% they can cut before they even have to start the QE. Like, where it's going to be V-shaped. Like, you're not, your downside is capped until like some austerity type political movement takes charge.
Yeah, so that's the other thing is, people are getting misconstrued now that, we had that hot jobs report last week, and that pretty much, we were looking at a November rate cut of potentially 50 bips, and that got totally priced out. And people are like, oh, this is bearish crypto. We're not going to get as many rate cuts. But the reason that's happening is because the economy is stronger than expected. So if we're in this world where inflation is almost at target, and we have a stronger than expected economy, and we're still probably going to get a 25 bips cut, how is that a bad thing, right? So I totally agree. It's just, the economy is better than we expected at it stands right now.
And yet somehow the crypto market isn't really reacting that way. To everything that we're talking about here. There are definitely some assets that are reacting that way. I think we've mentioned on our podcast Tau a bunch of times, and that's done extremely well. But Bitcoin hasn't. Ethereum certainly hasn't. Solana a bit, but not really. I mean, there's an argument to be made in a strong economy. If earnings are strong, if the actual value of these companies are going up because they're producing into a population that is willing to buy and willing to spend, and revenues are going up, that there's less appetite for these speculative assets, right? If you're betting solely on economic growth and you're not betting on increased stimulus, right, and unnecessary money that's being pushed into the system, you're just betting on the Fed is going to control the descent of rates, and we still have a good economy and things look nicely. That's really good for equities, but potentially what's needed is actually, I'm just spitballing, but potentially what's needed is the threat of a recession, where the Fed has to come in and they have to prop up the market, because that's what the crypto market is supposed to be defending against. A strong economy where companies are doing okay and everything looks good is actually good for the companies. They're not good for cash-producing companies. They're not necessarily good for something like Bitcoin until you get to the point of excess, until you get to a point of complete euphoria.
Well,
I'm just spitballing.
I have a question for you, Avi. Could it be that the sort of parachute that Bitcoin that's attached to Bitcoin, that's slowing it down, is regulatory policy uncertainty? Because I think that one thing that crypto needs to rally is adoption, and a lot of companies, from my former employers to name your traditional finance institution that's interested in either tokenizing assets or settling things on Ethereum, they're kind of in a holding pattern until they can get some regulatory clarity. Could it be
I agree. I agree with when you talk about the concept of crypto companies or anything outside of Bitcoin. But with Bitcoin, that regulatory uncertainty is actually good.
Yeah.
Because what it does is, if you're allocating in crypto, that by definition makes your allocation to Bitcoin larger, and so that's actually very good for Bitcoin, right? It gets a larger percentage of every incoming dollar into crypto.
I hadn't thought of it
when
that way.
There's high regulatory uncertainty about other assets. Yeah. Because Bitcoin is done.
Yeah.
Bitcoin it's good.
Yeah.
We're good.
Yeah, we're good.
Right?
Check mark.
It's not a security.
Yeah.
Don't worry. Although, isn't there some documentary coming out today?
It came out last night. I watched it.
Who'd they say it was?
What's his name again? Peter Tad. It was ridiculous. It was totally unfounded.
Totally unfounded?
Not totally, but basically it was like, there's a couple forum posts from this guy where it looked like Satoshi had changed into a different Bitcoin forum account that was this guy, and it looked like he was consigning his sentence on it.
Oh.
This paired with a few other things. I mean, he's a renowned guy. Like, there has been thoughts. I'm not too well versed on the whole who is Satoshi, theses, but it was ridiculous. It's pretty unfounded. I would say.
That's a shame. I was kind of excited. So I mean, bar that as a catastrophic event, it turns out that they uncovered Satoshi and then the wallets start to move and they start to offload BTC. I mean, look, Bitcoin's been hanging out okay. I do agree with you, Jonah, that regulatory uncertainty is very bad for altcoins.
Yeah.
Going to politics for a second, I think the issue is also just uncertainty.
Yeah.
Nobody actually knows what the Democratic Party position is on crypto. Everyone is unaware, right? And so there's kind of no way to make a bet on it. It's possible that it's a lot better than it was under Biden. It's possible that it's the same. I actually think it's kind of hard pressed for it to be worse, because I think people have woken up to the idea that crypto is actually important and it does drive votes.
Yeah.
But obviously Trump would be very good.
I think the theme right now they're getting on is just, the amount of uncertainty and confusion. Like, there's confusion on election outcomes, on policy decisions. There's a lot of confusion in the economic data. There's a lot of very smart people that, think we're about to go into a recession, and I want to respect that. Even though I don't think we're going to be in a recession, there's some guys out there. There's Mike Green, who's a very intelligent person, is pretty strongly in the recession camp. And I'll just quickly lay out his perspective and what some of the more articulate recession views are. Is a lot of it comes down to just bad economic data coming out of COVID and how that gets reflected in revisions. There's a lot of talk about non-farm payroll revisions. We've seen some major downside revisions. So, to simplify and distill the thesis is that things are a lot worse than they appear in the data.
I agree with that.
Mike Green is the index fund guy, the guy that made the argument about
like
index,
passive versus
passive funds. He's a bit of a doomer, though, isn't he? He's a bit of a doomer.
In some ways. I mean, he's definitely not a fan of crypto. I'll say that much.
Yeah.
But he's a smart, intelligent person, and that's what matters. Is when he, even though I disagree with it, I do listen to it. And to your point, there is downside revisions. We had negative 800K thousand, downside revisions to the jobs data over the last year. But look, it's fairly linear, the downside revisions, because it has to do with just the confidence interval of how they calculate it, and then how that actually comes into existence through basically tax data. So it's not as noisy as you think. It's not convex. It's quite linear. So there's some smart folks out there who have just basically baked the revision into the current data. So even though we got a gangbusters jobs report last week, just take a 50% haircut on that.
I think we might, I know there are some people out there who say we are in a shadow recession right now because of those revisions that you cite. I'm not quite in that camp, but I think we're in a shadow bear market, and I think that's why it's such a good time to dip buy. Now, how could that be with stocks and Bitcoin at or near all-time highs? Well, one thing I did recently was I went and denominated the S&P 500 chart in gold, and it's close to the lows of this millennium. Only during COVID did it go lower. And okay, you could say, well, Jonah, gold has ripped, so that's sort of all you're saying is that gold is up a lot. But the dollar's down a lot, and if you look at what equities are doing versus something that, like a precious metal that's technically a store of value, it tells you that the stock market is not in a bull market, that it's actually in a bear market. And I think it's important to make that distinction, because it basically tells you that all of this sort of froth and asset inflation that has everybody all giddy and looking at larger and larger numbers in their brokerage accounts is really a mirage. And I think that there's some pretty sinister underlying factors in the economy that need to be addressed, specifically those related to what inflation has done to everybody's balance sheet. Like, even just out there, we were speaking to the barista when we were getting coffees here. We had sticker shock. Utah's supposed to be cheap.
Yeah.
Two coffees is
like 2 coffees was $10.
$10. And
it's crazy.
And the barista was just like, we're suffering.
Yeah.
She literally said, "We're dying over here," which is kind of sad, because obviously income is much lower out here, but the prices are not. I mean, I went to a place yesterday, got nachos for $24, one plate of nachos.
It's cheese and
it was like the nachos are pretty good. I'm not gonna lie, they were very good nachos, but like
I live in London, and when I moved to London 10 years ago, London felt like the most expensive place I'd ever visited. Now it feels literally like half the price of living in the United States. So I'm not like daily life. I'm not talking about like central London real estate or anything. It's crazy what's happened.
I mean,
here.
it's this K-shaped economy thing. It is true. Like I don't want to belittle it. Like there's people in the lower income classes that are in a version of a recession, and a lot of it has to do with affordability. Is, we haven't seen a classic inflationary recession, whatever you want to call it, cost of living crisis. We haven't seen one of these in a long time, so it's a bit confusing. We're used to deflationary credit shocks that sort of unwind the financial markets. We're sort of seeing the opposite. Asset holders are doing really well. Asset markets are doing great, but people in the lower income classes are getting squeezed. The problem is that, they're not the asset holders as much, so we don't see it as much.
So yeah, 100%. And one thing that I know, there are a bunch of smart macro listeners on this podcast, so they probably picked up something Jonas said, and they're thinking to themselves, well, you get dividends from the S&P, so obviously you can't compare that against gold. And I'm here to tell you, go look at the charts. If you reinvest your dividends, it's still flat since 2000.
Yeah,
it's nuts.
You can total return adjust.
It's right? Right? just to be clear on that point.
It's nuts.
It is, I mean, even though we're sitting here saying it's been really good for asset holders, I think part of the reason that it hasn't been good for everyone else is a little bit of that chart, right?
Yeah.
And it is sad, and the question is, is it fixable right now? That's sort of question number one. And question number two, because we're all investors, is, well, what do you do about it, right? Like, where do you put your money because of that? And I'll pose the question to you before I give my take, but I'm curious. If we all agree, we're all sitting here and we say this is the case, the economy is bifurcating into asset holders and non-asset holders, what does that mean?
Honestly, I think the biggest thing is the risk for the sanctity of the Fed in terms of its credibility. A lot of the Fed policy creates wealth disparity. QE is a policy that ensures that asset prices can rise without it trickling out into the broad economy. Because again, like I said earlier, QE it's a swap of assets. Really, it's some people call it money printing, probably, but in reality, mechanically, what happens is that the Fed goes out and buys something that is a lot more liquid, like bonds, and swaps it for central bank reserves that get caught up in the financial system that only banks can hold it on their balance sheet. So that's slowing down the velocity of money, removing duration from the market, and lifting up asset prices. It's a pretty impressive mechanism. That does great for asset holders, but it does nothing, at the same time during QE, they're buying MBS, right? They're buying up mortgage-backed securities. That's going to make housing more unaffordable. So these policies are not great for the lower income classes. So tying that into what we could see in the future here, I think the Fed's credibility is at risk from a few different vectors. The wealth disparity one, for sure, as we move into like a continued, rate cutting cycle, even though parts of the rate cuts are more sensitive to either like smaller companies, smaller like lower income classes, car loans and that sort of thing. And also like a lot of smaller companies are on floating rate debt versus fixed rate. Somebody like Apple can just have a stupidly low yield on their issuance versus like a smaller company, they have to go fixed. So that's more sensitive to rate cuts. So there's some validity to it, but overall, if we're cutting rates, again, going back to the simple framework, if we're cutting rates into an economy that is growing and not in a recession, that's going to accelerate things. And so there's been a lot of talk about how, this question of who's going to buy the debt, who's going to buy the bonds. Coming out of, we obviously saw TLT just absolutely crater during the rate hiking cycle, just do the basic bond math. But coming out of that, they're starting to be concerned that, okay, if the Fed's not doing QE, other foreign central banks are not, they're actually net sellers of debt. Who's going to buy the debt? Well, if we get a recession scare, that's going to bring in a flood of money to buy in the long end bond. So that's fine. At the same time that Yellen is limiting the amount of issuance on the long end. So that's all well and good. We've been in this little Goldilocks environment. But what happens if we keep cutting and we get an economy that starts to soar and we see nominal GDP just start to go vertical, even though it's been very resilient? If that happens and we start to see inflationary concerns, I'm pretty concerned about who's going to actually buy the long end bond during this next phase here, because their magic trick of getting the recession scare to get that rotation in is effectively it just finished. Long end bonds have been going up higher. So if these dynamics all happen at the same time, the Fed's credibility is going to be at risk. Like it could be pretty significant. And tying that into some of the assets that we own, I think that's the reason why you're seeing gold get bid up. I think Bitcoin, I remember in 2020, I was long gold, I was long Bitcoin, and gold was just killing it every day, and I was pretty frustrated. I was like, why isn't crypto going up? And it just had to wait a few months. Maybe that's what's happening again. But again, I do think if this is actually how it transpires, the Fed's credibility is going to be at significant risk. So you want to own those type of assets, I think.
I think it's a generational thing as well. Like, I think your TradFi listeners and my sort of TradFi suit-wearing former colleagues wouldn't be paying attention to memes like the one I'm about to describe, but there's a popular meme in crypto, which is, you have a few years to hyper gamble your way into elite status. Otherwise, and I'm not going to use the 4-letter word associated with this, otherwise you're basically a wage slave for the rest of your life. And I think that meme holds a lot of water for younger generations because having worked with younger people now, I'm almost 40.
Yeah.
I'm kind of the old man in the trading world. I'm a dinosaur. When I talk to younger people, they're not buying gold. They're buying crypto, and it is, like you said, there is a bifurcation going on. There's inequality increasing under either a Trump administration or a Harris administration. Neither of those politicians seems to have proposed anything that would arrest the inequality trajectory that we're on. So I think when we start to get this next phase of liftoff in crypto, which I'm convinced is happening, I think you're going to see some massive, Gen Z and younger millennial pile in to try and ride that wave, because we've all learned what happens when you get left behind. To quote the barista, it's a struggle.
This is a key point that you bring up, is going back to the original question, what happens when there's a bifurcation in an economy of haves and have-nots, is you get the world right now, it's so easy to see the other half. 100 years ago, you couldn't see the other half that easily. If you were of the have-nots, you maybe didn't feel that way in a tremendous portion of your life because you wouldn't see them. You simply would not interact with them. You would see maybe in the newspaper, but you couldn't go on TikTok and watch videos of people taking crazy vacations and feel to yourself, oh my God, I'm never going to make it. And so there's this idea of I need to get out of where I am to get to where I need to be that has never really existed before in such a large scale, because it's so easy to see the other side. And that's what leads to the gambling. That's what leads to the investing in meme coins. That's what leads to the DraftKings of the world taking off in such a big way. It's that FOMO, it's that culture.
Yeah.
And so I do think that what you see is you're going to see a lot more money spent on these types of activities. And these are hard-earned lessons. These are hard-earned habits.
Yeah.
There are people that are going to do this for basically their entire 20s. They're going to inherit what their parents have, and then they're going to do it at an even greater scale. And that's why, again, so even if you throw out, like, let's pretend that Bitcoin is completely useless, there's a tremendous wealth transfer that's about to occur over the next 20 to 25 years. And based on the culture that we've established for ourselves, there's an appetite for gambling.
Yeah,
totally. There's an appetite.
And I think it's
for
rational in a way.
And it's happening.
Yeah.
Look, I don't know if it's necessarily rational. I want to hear you out, but just I think it's a function of feeling like you don't have what you need to have.
Yeah.
I do happen to think that a lot of people in this world are much better off than they were 30 years ago, and so it's a comparison game, not necessarily a rational thought process. But
maybe logical is more the word. But
but these are global phenomena, right? Like in the U.S., Gen Z has the option to buy, IBIT or GLD, so Bitcoin or gold. If you live, if you're a younger person in Mexico or Bolivia or something, I'm not sure if you have that GLD option, but you can certainly buy Bitcoin on Binance, right? So I even if it weren't for the fact that young people overwhelmingly prefer to gamble on crypto versus other assets like gold, even if that weren't the case, just access alone is too bottlenecked for traditional, let's call it debasement hedges like gold. And the next debasement sort of adventure that the governments of the world decide to embark upon, I think crypto, specifically Bitcoin, to your point, you talk a lot about reflexivity, Avi, after you read the Soros book. Like, I think that Bitcoin will be the reflexive asset once we break through new highs. I think there'll be a lot of chasing. And frankly, like, even if you don't believe that, Bitcoin is the most performant asset of this millennium. It is impossible to ignore the stellar performance of this thing called Bitcoin. And I think that the next leg higher, again, like it's going to, the tulip analogies will fall by the wayside.
Yeah.
Well, this has already gone on a lot longer than tulips did.
Yeah.
That's the thing. Yeah. People always post that, but like every cycle, it beats it, and disproves that.
I mean, how tulips didn't last more than 5-6 years in aggregate in terms of their boom. And the other thing that people always mention, oh my God, it's the most annoying thing in the world. They always bring up the tulips as if that's the only financial bubble that's ever existed in the history of financial bubbles. No, you guys are cherry picking the one that didn't work.
Yeah.
Come on. I mean, not to get annoyed about this, but did you know that in the 1800s there was a canal stock bubble?
I actually did know that.
After they built the Erie Canal, it was so exciting to people, the concept of a canal to move goods, that hundreds of different companies popped up to raise money to build their own canal, and it buoyed the stock market, and it went up in a straight line until they all collapsed because nobody actually built the canal. Did you know the same thing happened with railroads, and the same thing happened with airline stocks? Yeah. In the early 1900s, every company became the Long Island Airline Company instead of Long Island Blockchain.
Yeah. Oh my God!
I mean, and guess what? All of those technologies turned out to be pretty good. I mean, the Erie. Well, actually, the Erie Canal was railroaded by railroads, but no.
Yeah.
It is a bubble that hasn't died. And when a bubble doesn't die and roars and comes back to life, it is your job, if you are a rational investor, to at least take it seriously.
Yeah.
You don't have to. Your conclusion doesn't have to be the same as mine, but you do have to take it seriously.
Do the work, at least a little bit. Should we, what's going on in the chat there? Should we grab a couple questions, or if people are watching, fire in some questions there. We can answer a couple here.
I bought milk with my BTC the other day. Milk, the beverage of criminals.
Wow, this chat.
That is, I'm actually really curious. Where can you buy milk with Bitcoin? I might start.
El Salvador.
While we're waiting for the answer to that question, sorry, it's too ridiculous.
I mean, the beverage of criminals that's a great tagline.
Yeah.
Got milk? No.
Milk, the beverage of criminals. Their new campaign. I wouldn't. There are milk futures out there.
There are.
I'm sure.
Yeah.
There are.
Don't buy those though. Super liquid.
I love that.
What I would say about this massive wealth transfer that Avi pointed to and alluded to is that when it does take place, and it's already starting, boomers to millennials and Gen Z, that wealth transfer, like, how old are you, Fijo?
30.
30. Okay.
Yeah.
I'm 39.
Mm-hmm.
I want to ask you a follow-up question to that. My parents advised me, a penny saved is a penny earned. Keep it safe. Don't invest in risky stuff like stocks. Just save your cash. It was the worst friggin' advice I've ever gotten in my life. Did your parents advise you of that too?
Yeah, my parents are super risk averse, and it's like never take debt. I mean, I understand, don't lever up on stupid consumer stuff,
my
but
point is,
that
like,
can be a good thing. Yeah.
When all of our parents advised us like that, and then we watched them get rich off of their real estate, and then buy houses in the hills on government salaries for 70 grand that suddenly become worth, $1, $2, $3, $4 million, and then our generation inherits that. We're going to say, well, what worked for them, and what's going to work for me? Is it going to be saving money in cash while the money printer runs overtime, or should I invest in the real estate of our generation, which is overwhelmingly digital in terms of where people spend their time? Like, to your point, Avi, I really do think that wealth transfer is something important to be monitored for our space.
Yeah, hugely. I mean, it's funny when I look at my dad and how he made his money. I mean, he's retired and he has a pension. I don't think I'm going to get a pension.
No.
I don't think that's really going to exist when I'm 65.
That window's closed for us.
He actually never invested any money. This is actually an interesting, incentives, right? What are your incentives? He knew that he was guaranteed a pension of a certain amount until he died. So he never had to invest any money. right? He would just spend his money on things or put it in a bank account, and he didn't worry if that bank account lost money because he knew he was getting a pension. Nobody in our generation has that luxury.
We might not even get
right?
Social Security.
No. Yeah, that's going to be an issue one day too. Yeah, like it's going to run out.
Well, it's going to go one of two ways.
Yeah.
Either we're going to get tons of it and we're going to have communists in charge, or the capitalists are going to basically take it away because the budget doesn't work out when you leave it in there.
Yeah.
So
I mean, even just a point here, even the staunchest capitalists don't care about the budget anymore.
Yeah, it's
in our
nuts, isn't it?
country.
And that's the thing, getting to like the election outcome thing. Yes, there's slight differences in terms of policy, but the vast majority is going to be the same thing, which is we're going to print, we're going to run a deficit. It's just about how.
Yeah, it's there's no concept of balancing the budget.
No.
Of not spending too much. It's what are we going to direct our efforts towards? And I think if you really think about it, it's the culture of the states that is the crux and the focus of everyone right now.
Mm-hmm.
It's not about what we're doing with our money. It's about how we interact with each other. That's become the governing philosophy of politics.
And to your point about TikTok and seeing other people's wealth, until that ends, which it probably won't, cash is trash. No government is going to have the mandate to go into austerity. Like, you have to be long leveraged risk assets, of which crypto is one of them.
Yeah, the hurdle rate is high.
Yeah.
Before we wrap up, I want to, with the interest that you guys are going to be doing a live recording later today on the panels here, and you'll be talking a lot about your current market views, but just want to get a little, hint as we wrap up here on, where you see price right now and where you see it headed. And we've talked a lot about the high time frame, but what are you guys looking at in terms of low and medium term?
Low time frame, guys, I don't know. I have literally no idea. And the reason I have literally no idea is because heading into the election, you're going to see a lot of chop, in my personal opinion. I don't think anyone is able or capable of taking strong positions ahead of the election because the outcome is for all of crypto is so divergent pre-election that what you're probably going to see is a lot of chop. And it might, some of it might actually look like momentum. You might get faked out. We might go up 15% because a bunch of shorts pile in and they get squeezed. I think the true is true of equities as well. I do genuinely believe that there's probably just we're in a waiting period. Right now.
I'm wondering what you guys think about this, but when I look at just the amount of hedges on right now, like if you look at like the VIX contracts for next month, the next couple months, people are so hedged right now that I feel like this is a working theory, but regardless of the election outcome, it's going to be an incredible rally just from the hedge unwinds. What do you guys think?
Well, put it this way. Let's start with crypto and then let's go to equities. For crypto, I agree with Avi. Impossible to trade the short term. What I'm looking to do is stay up all night on election night. If Trump wins, I'm going to buy a breakout. It's good, like even if it's 63K Bitcoin going into the sort of polling, and then it trades up to 75 on a Trump win, I'm buying 75s.
Yeah.
Right. If Kamala wins, I'm just going to sit on my hands and wait for it to nuke and go sideways, and then when the action stops, then I'm going to buy. As far as equities are concerned, to your point about hedges, I think we're going to create volatility, but if you're trading your personal account, you don't care about Sharpe ratio. You don't care about drawdowns as much. So basically, every time I get in, I'm already kind of maxed out on SPY. What I'm doing when I get my cash inflows these days is I'm buying equal weight S&P. I'm buying the equal weight S&P 500 ETF because I think that sort of the Magnificent Seven have run quite a lot, and I think it's time to invest in other American companies, a diversified portfolio. I'm not an equities expert, but I do think it's time to diversify away from NVIDIA and Meta, and Google.
Well
that's
said.
what I'm doing. And in terms of hedge unwinds, if we get a bunch of hedge unwinds and there's this explosive melt upwards in the equity markets and Bitcoin, do you chase it? If it's Bitcoin on a Trump win, yes. If it's equities on a hedge unwind before the election, probably not, right?
Cool. Well, that was a lot of fun. I've been looking forward to doing this for a long time with you guys.
Me
it's
too.
great to get the two pods together, and maybe we'll do it again sometime.
This has been awesome. Thank you so
Excellent.
much.
Thank you for having us. It's a real honor.
I really enjoy it.
Yeah. We've been on forward guidance, Avi.
brother.
We
Boom.
made it. All right.
We made it.
Thanks, everybody.
Sick.
Thanks, guys.
Thanks, man. How was that?
That was fun.
That was really